Hey everybody, this is Jack Allwell with another Money episode, and today we are discussing if you want to call it, debate between George Gammon and Michael Saylor. Now, George Gammon wanted clarification on Twitter on if Saylor had actually recommended taking out debt to buy Bitcoin. He had said no, that he really was an advocate, though, of if you have very low debt in a very high inflationary environment, not to pay off the house. Now, I have heard Michael Saylor speak a lot, and I was under the impression he was advocating for taking out debt to go buy Bitcoin. And I'll play you a clip of why I think that from a Bitcoin fundamentals episode from the Investors Podcast Network. Basically, I think they're both on the same side in the sense that they agree that government intervention leads to inflationary policies, and the more government gets involved, the more that inflationary environment compounds on itself. But let's get to the debate and see what they have to say.
Labor policy, all these policies can create inflation. And my general view, and I think most Bitcoiners' general view, is we want less government, and we believe that most public policy intervention is inflationary. And inflation itself, caused by a political process, generally is not good for the world. And if the politicians weren't passing a law making it illegal to manufacture something somewhere, then someone would have manufactured it and they'd be selling it to you cheaper. And so the market economy is functioning in order to drive the price of everything down whenever it can, and the public policy is driving it up. If you would like to tell, by the way, George, I'll agree with you. Nobody should buy Bitcoin with their credit card. I have yet to meet anybody that says they bought Bitcoin with a credit card. I'm not a fan of credit card debt, and I've never recommended people go into debt to buy Bitcoin. I've said that the inverse, which is if you had a 30-year mortgage and it was a 2.5% interest, you're deciding whether you should pay off your mortgage for the rest of your life or whether you should carry the mortgage forward. I think that when you're in a financial, an environment of financial repression, that is the definition being if the inflation rate's 10% and the mortgage rate is 3%, in that repression environment, you're better off to carry debt. In an environment where it was the inverse, if the inflation rate was 3% and the interest rate was 10%, then of course you'd be better off to carry equity. And so the other point I've made, George, though, is you talk about the government, but in fact there's 180 different governments. So you could say, well, I think that the United States didn't create as much money as whatever. Well, what about Venezuela, and what about Argentina, and what about Brazil, and what about everywhere? Everybody in the world, all 8 billion people, is struggling with money supply or currency supplies that are being manipulated by every government. They're also struggling.
Okay, so you did hear him say he's never recommended people taking out debt to buy Bitcoin. I don't want to harp. I don't even really care if he did say that. Like, everyone's got to make their own decision. It seems a little reckless to take out crazy debt to go buy anything, really. But I'm going to tell you why I thought he was recommending that. And this was back from the first time I heard Michael Saylor speak, and he really changed how I view inflation and how it should be personalized. It's kind of like a vector of all the items that you want, that you are either buying a lot of or that you aspire to buy. Because his argument is kind of CPI is, well, number one, manipulated, and it assumes you don't really want to be wealthy. Like, you don't want the nice, beachfront property in Miami. Like, there's no type of, geographical assets involved, or things that most people aspire to have, and that's not really captured. So you need to come up with your own inflation index, sort of to say. So, but let's get to Bitcoin fundamentals, number 5 podcast episode, where Preston Pysh from the Investors Podcast Network is talking to Michael Saylor, and this is why. And tell me how you see this, because to me it sounds like he's recommending taking out debt to go buy Bitcoin.
Be 20% accretive. Now I have $1.5 billion that's going to generate $300 million a year in tax deferred investment income with the $50 million from the core business. Now you're up to $350 million. You can see that it's not that much further, if it keeps increasing, that you end up generating more income per year than the revenue of the company was last year. Now, you can do that with anything. For example, if you're a dentist,
As long as you got free cash flows.
well, as long as you've got any assets at all. If you have no monetary energy to speak of, well, that's a problem. But let's say you're a dentist and you've got a great dental practice. You get 500,000 in revenue a year, and you manage to save 50,000 a year, and you have 500,000 in the bank, or 500,000 in stocks and bonds and real estate. Sell that stuff, invest in Bitcoin, sweep your excess cash in Bitcoin. It's the same exact calculation. Now you're generating 3x your cash flows. Instead of losing capital, you're making it, and you're compounding. And then you're the dentist, so you go and you mortgage your house, take a 30-year mortgage at 3% interest, finance it, take 500,000 out, and now you've got $1 billion of Bitcoin. Or borrow against the dentist practice, right? Now you've got $1 billion on your balance sheet, and you're generating $200,000 a year in tax deferred income with your 50,000 from your practice. Now you're making 250,000 a year. Now you're beating the hurdle rate. And so, for an individual, the logical thing to do is you borrow against assets at a very low interest rate. You invest in an accretive asset that's going to have a high tax deferred yield, and you sweep all of your fiat cash flows into the accretive asset, because they're just going to, depreciate if you don't. And so that's the Bitcoin standard. That's what I did. That's what my company did. And we're kind of showing it.
So if that's not saying, like, basically, if that's not a recommendation to take out low interest debt to go buy Bitcoin, I'm not sure what is, but let me know what you think. I mean, one thing on the debate that was brought up that I can also share, and I've heard George Gammon speak on this a couple times now. He refers to this long-term trends.net, where he's looking at the money supply over time versus the consumer price index. And he brings up the point that if you look at really any 30-year period, you're seeing high money supply growth, or M2 money supply growth, and oftentimes you get very little inflation. So the money supply is the black line in this, and the CPI is red. And his argument is it's not really the money supply that is causing the inflation, or the root cause. It's that is real GDP outpacing the money supply growth. And said, I think another way from him is the government's percentage of GDP going up or down? And his argument is, as it's going up, the inflationary pressures are going up. So take that for what it is. Let me know what you think, if you had any views on the debate. Once again, I'm Jack. I would greatly appreciate it if you like and subscribe this channel, and I will talk to you in the next episode. Bye.